Ladies and gentlemen, Asian guy here. I need you to stop what you're doing right now. Put down the remote. Close the Netflix tab. Something just happened in the bond market that changes everything we thought we knew about the Federal Reserve's next move. The 10-year Treasury yield just spiked above 4.85%, and this isn't some technical bounce. This is the bond market screaming at Jerome Powell, telling him his entire plan is about to collapse. For months, we've been told the same story. Inflation is under control. The Fed has won. Rate cuts are coming. The soft landing is guaranteed. The bond market believed that fairy tale for exactly 127 days. Today, that belief just died a violent death. The yield curve is steepening so fast it's making traders physically sick. The 30-year bond is getting massacred. Corporate debt is imploding. And the timing of this carnage? 3 days before the most important Fed meeting of the year. This is not a coincidence. This is the bond vigilantes declaring war on the Federal Reserve. They're telling Powell that his dovish pivot was premature. They're telling him that the inflation monster isn't dead. It's been hiding, waiting for the perfect moment to strike. And that moment just arrived. Look at the numbers. The 10-year yield has surged 47 basis points in just 5 trading sessions. That doesn't happen in a healthy market. That happens when institutional investors panic. That happens when pension funds realize they've been holding worthless paper. That happens when foreign central banks start dumping U.S. debt like it's radioactive waste. But here's where this story gets terrifying. The Fed is trapped. They painted themselves into a corner by telegraphing dovish intentions for December. The market was pricing in a 25 basis point cut with 97% certainty. Now, with yields exploding higher, Powell faces an impossible choice. Cut rates as promised and watch the bond market burn down the entire financial system. Or hold rates steady and admit that everything they've said about inflation being conquered was a lie. The bond market is essentially calling Powell's bluff. It's saying, you want to cut rates? Fine. We'll make borrowing costs so expensive that your rate cuts become meaningless. This is financial warfare at its most sophisticated. The invisible hand of the market is slapping the visible face of the Federal Reserve. Think about what happens when the 10-year yield hits 5%. Mortgage rates explode past 8%. Corporate borrowing costs become prohibitive. Regional banks, already sitting on hundreds of billions in underwater bonds, face insolvency. The commercial real estate sector, barely hanging on with current rates, collapses entirely. This isn't just a bond market tantrum. This is the preview of a systemic reset. The international implications are even more dangerous. Foreign holders of U.S. debt are watching this yield spike with growing alarm. China holds over $800 billion in treasuries. Japan holds over $1.1 trillion. When yields spike this violently, it signals to foreign investors that the U.S. is losing control of its own monetary policy. It signals that the dollar's reserve currency status is under threat. It signals that the 80-year cycle of American financial dominance might be ending. But the Fed's real nightmare isn't the bond market revolt. It's what happens next. Because when borrowing costs spike this aggressively, it doesn't just affect new debt. It affects the entire $50 trillion U.S. debt market. Every corporation that needs to refinance, every government entity that needs to roll over bonds, every pension fund that needs to meet future obligations, they all just became significantly more expensive to fund. The timing of this crisis exposes the Fed's fundamental deception. They've been claiming victory over inflation. While core services inflation remains stubbornly high, they've been celebrating falling headline numbers while ignoring the fact that housing costs, medical expenses, and financial services are still rising at unsustainable rates. The bond market just called them out on this statistical manipulation. This yield spike is particularly devastating because it's happening during what should be a seasonally strong period for bonds. December is typically when institutional investors rebalance portfolios, creating natural buying pressure for treasuries. Instead, we're seeing historic selling pressure. This suggests that the selling isn't tactical, it's strategic. Major players are repositioning for a fundamentally different interest rate environment. The feedback loops are becoming self-reinforcing. Higher yields make existing bonds worth less, forcing mark-to-market losses across the banking sector. Those losses reduce lending capacity, tightening financial conditions, even without the Fed raising rates. The tightening financial conditions slow economic growth, reducing tax receipts, and increasing government borrowing needs. Increased borrowing puts more pressure on bond prices, driving yields even higher. Powell understands this death spiral. He's seen this movie before. In the early 1980s, Paul Volcker broke the inflation psychology by allowing interest rates to rise until the economy screamed for mercy. But Volcker operated in a different world. Government debt was manageable. Corporate leverage was reasonable. Financial markets weren't dependent on perpetual easy money. Today's economy can't survive the Volcker treatment. This creates the ultimate central bank paradox. The Fed needs to be hawkish to maintain credibility with bond markets. But being hawkish destroys the over-leveraged economy they've created with 15 years of easy money policies. They're trapped between the bond market's demand for higher rates and the economy's need for lower rates. There is no middle ground. The international dollar system compounds this dilemma. When U.S. yields spike, it creates a vacuum that sucks capital from emerging markets. Their currencies collapse, their inflation accelerates, and their debt service costs explode. This forces their central banks to defend their currencies by raising rates, creating a global tightening cycle that eventually feeds back into U.S. economic weakness. What we're witnessing isn't just a bond market correction. It's the beginning of a monetary regime change. The 40-year bull market in bonds is ending. The era of declining interest rates that powered the greatest debt expansion in human history is over. We're entering a world where debt service crowds out productive investment, where government borrowing costs become unsustainable, where the Fed's ability to manipulate markets is finally overwhelmed by mathematical reality. The yield spike ahead of this Fed meeting is the market's way of saying the game is over. No more financial engineering, no more can kicking, no more pretending that debt doesn't matter as long as interest rates stay low. The bond vigilantes are back, and they're not interested in the Fed's political considerations or market-friendly guidance. Powell will walk into that meeting room knowing that every word matters. Every hint of dovishness will be punished by higher yields. Every suggestion of hawkishness will be tested by market volatility. The Fed has lost control of the narrative. The bond market is now writing the script. The derivatives market is where this crisis becomes apocalyptic. The notional value of interest rate derivatives is over $400 trillion globally. When yields spike this aggressively, it doesn't just affect the underlying bonds. It creates massive mark-to-market losses across the entire interest rate swap complex. Banks that thought they were hedged discover that their hedges only worked in a world of gradually changing rates, not violent spikes. Credit markets are already seizing up. Investment-grade corporate bond spreads are widening. High yield is getting crushed. The leveraged loan market is freezing. Companies that planned December refinancing are suddenly facing borrowing costs that make their business models unviable. Private equity firms that loaded portfolio companies with debt are staring at bankruptcy cascades. The municipal bond market is particularly vulnerable. State and local governments that issued floating rate debt or short-term paper are seeing their interest expenses explode in real time. California's recent bond issuance had to be repriced twice in 1 week as yields spiked. This is the preview of the fiscal crisis hitting every major American city over the next 6 months. Insurance companies and pension funds are facing a liquidity nightmare. They hold massive portfolios of long-duration bonds that are getting slaughtered by rising rates, but they can't sell without realizing devastating losses. They're trapped in a classic asset-liability mismatch that threatens their solvency. When insurance companies fail, it doesn't just affect policyholders. It affects the entire risk transfer mechanism of the modern economy. The housing market is already responding to the yield spike with panic. Mortgage applications dropped 28% in 1 week. Existing home sales are crashing. New construction permits are being canceled. The housing wealth effect that powered consumer spending for 2 decades is reversing at light speed. When housing crashes, consumer confidence follows. When consumer confidence crashes, the economy enters recession. Regional banks are facing an extinction-level event. They hold $620 billion in commercial real estate loans that are about to go underwater as cap rates adjust to higher interest rates. They're sitting on $600 billion in underwater Treasury and mortgage-backed securities. Their deposit costs are rising as money market funds become competitive again. This is the setup for a banking crisis that makes 2008 look like a warm-up exercise. The Federal Reserve's balance sheet has become a weapon of mass financial destruction. They hold $7 trillion in bonds and mortgage-backed securities purchased at much lower yields. Every basis point increase in rates reduces the value of their holdings by tens of billions. The Fed is technically insolvent on a mark-to-market basis. The institution responsible for monetary stability is itself a casualty of the very policy it implemented. Foreign exchange markets are amplifying the crisis. The dollar is strengthening aggressively as higher U.S. yields attract capital flows. This creates a feedback loop where emerging market currencies collapse, forcing their central banks to defend with higher rates, creating more global tightening, driving more capital to dollar assets, pushing U.S. yields even higher. The repo market is showing signs of stress. Overnight funding rates are becoming volatile. Primary dealers are reluctant to make markets in treasuries. The plumbing of the financial system that everyone takes for granted is starting to show cracks. When repo markets malfunction, it affects everything from money market funds to corporate cash management. This isn't just an American crisis. European government bond markets are cracking. German bond yields are spiking in sympathy. Italian and Spanish spreads are widening as investors question the European Central Bank's ability to maintain yield curve control. The Bank of Japan is facing massive pressure to abandon yield curve control as the yen collapses against the strengthening dollar. Central bank coordination is breaking down. Each central bank is being forced to prioritize domestic stability over global cooperation. The synchronized monetary easing that defined the post-2008 era is being replaced by competitive tightening. This is the environment that historically produces currency crises, sovereign debt crises, and global recession. The commodity markets are responding to the crisis with their own form of chaos. Energy prices are spiking as higher interest rates threaten recession, creating supply disruption. Agricultural commodities are volatile as farmers face higher financing costs for equipment and inputs. Precious metals are caught between safe haven demand and rising real yields. The entire commodity complex is being repriced for a higher interest rate world. Corporate America is about to face a refinancing wall. Over $1.4 trillion in corporate debt matures in the next 2 years. Companies that issued debt at 2 to 3% coupons are looking at refinancing costs of 7 to 8% or higher. The zombification of corporate America through cheap debt is ending. Only the strongest companies will survive the reset. The venture capital and growth stock ecosystem built on zero interest rates is imploding. Companies that never generated positive cash flow are suddenly being valued on fundamentals rather than growth narratives. The private equity model of financial engineering through leverage is breaking down as debt becomes expensive. An entire generation of investors who only knew falling rates is about to learn about credit cycles. The contagion is spreading through channels most investors don't understand. Exchange-traded funds holding bonds face massive redemptions as retail investors panic. When ETF shares trade at discounts to net asset value, it forces authorized participants to sell underlying bonds for redemptions. This creates additional pressure. Money market funds are about to become the eye of the storm. As short-term rates spike, billions flow from bank deposits to money market funds seeking higher yields. This deposit flight will accelerate banking crisis and force the Fed to choose between bailing out banks or watching collapse. Psychological damage to Fed credibility extends beyond markets. Congress is questioning Powell's competence. Foreign central bankers are criticizing Fed policy. Financial media that celebrated the soft landing is suddenly discovering the emperor has no clothes. International bond markets are beginning to decouple from U.S. treasuries. This breaks correlation structure portfolio managers rely on for risk management. When correlations break during stress, it amplifies volatility across all asset classes. The yield spike is revealing structural fragility of everything bubble. Real estate investment trusts are collapsing as business models become uneconomic. Utilities are getting crushed as dividend yields become uncompetitive. Infrastructure companies face insolvency as financing costs exceed returns. What makes this crisis unprecedented is speed of unraveling. Previous bond crises developed over months. This crisis is unfolding over days. High-frequency algorithms amplify every move. The financial system's complexity is turning a correction into potential systemic collapse. Federal Reserve's meeting this week isn't about monetary policy. It's about crisis management. Powell will choose between credibility and market stability. He'll choose between fighting inflation and preventing collapse. The bond vigilantes have returned with vengeance. They know political pressure and market volatility force policy mistakes. They're betting Fed will blink first. Judging by the speed of this yield spike, their bet is paying off.